Hello, friends. The old Wall Street saying goes trading profits are the most difficult, easy money profits you will ever make in the markets because the market is very tricky to trade. It's got a lot of subtle catches, moves, fake rallies, fake declines, and WYSIWYG. WYSIWYG in the sense what you see is what you get exists only in computer programming, not in financial markets. Here, everything that is appearing may be true, but the reverse is also true. And believe me, one of the most trickiest markets to trade is a bear market rally. I'm Vijay Bhambwani. I'm a prop trader. I've been trading these markets since 1986. And in my videos and through my videos, I want to help my friends, my followers navigate through the markets better, become more profitable traders, and get higher return on investments. So, that said, let's now take the example of why counter cyclical, which is when the market is going down, a sudden up move occurs, which is counter to the previous move. And when the market is going up, a sudden down move occurs, which is also counter cyclical. Why counter cyclical moves are so tricky and why do they take us by surprise? How to identify them and more importantly, how to profit from them. So, bear market rallies invariably will occur on small volumes. Why small volumes? Because the bulls are tired. They've been supporting the price. They've been averaging their long positions. It's not really helping much. The prices are sliding. Sure enough, there are some value buyers who are coming out there and buying in small bits and pieces because they are in a disciplined manner buying small lots. And the only guys who are really buying aggressively and happily are the bears who've shorted the market at significantly higher levels. For them, a falling market is actually providing trading profits, so they are very happy to buy. Overall, the volumes will be small. Now, the trade book will appear lopsided. What is the trade book? If you highlight any stock and click on F5 on your computer or hard press on the security on most of the mobile phone trading apps, you will get the best 5 buyers and the best 5 sellers. This is the snapshot window. This is your trading cockpit. Now, the snapshot window will suddenly start showing you that the total number of buyers in the market are far exceeding the total number of sellers. The reason being, the market prices are going higher, therefore selling pressure eases. This leads to the misconceived notion that the bulls are back and the markets have turned into a bullish market. And since loss-making bulls are not selling much, this misconception goes forward that there is less supply coming at higher levels, and therefore people start talking about a bull market beginning all over again. The third and very important, most important critical point I would say is the bid and offer spreads. I swear on screen reading as a skill and the snapshot window being my best friend as a day trader. Now this snapshot window will suddenly start to show very wide bid and offer spreads. How does it matter to you, you ask? Okay. Now if the difference between the buyer and the seller is say 2 rupees per share and there is enthusiasm in buying. Remember, both bulls and bears are buying. The bears are covering their shorts. The bulls are getting their toes wet. They're trying to average their loss-making positions by nibbling into the market. So there are very few sellers. So the buying bias exists. And because the spread is so wide, every time a buyer chases the price and buys at the best available offer price, your chart will show a big jump in the price. So the amateur chartist will tell you that the candles are getting bigger. Hey, it's not the candle getting bigger. It's because of the wide spreads. So you might be looking at the quantity of the move, my friend, but you have ignored the quality of the move. It's an illiquid market, the spreads are too wide, and this is a classic sign of a bear market rally. The market is not very well supplied at all. So this is why I tell people who follow me and connect with me on social media, you must combine a behavioral aspect of trading with screen reading, with statistical analysis and chart reading. Use any one of them in isolation and you're bound to fail. It's a complete 360-degree exercise. All right. So now that we know how to spot these tricky bear markets, the question is, how do we profit from them? So identifying them is done. You ask me, Vijay, can there be a possibility of making money? Hey, that's what I'm here for. If there is a problem that exists in the market, remain assured a solution also exists. And we want solutions that are mathematically viable, not just emotional hope in nature, but concrete mathematical and statistical steps. So, obviously, when short sellers have covered their desired quantity, they will stop buying and the price will start to ease down again. This is where you will start to get opportunities to short sell the market and make money out of it. So, is it possible that you should be going out there and shorting any and everything that you fancy free and short at random? The answer is no. There must be a method in the madness. The game is full of probabilities, mathematics, and statistics, and therefore you must go by the mathematic rule book. What we really want to do here is use statistical models to help us save the day. That is what happens when bear market rallies end. People who are statistically savvy get an edge over the markets, and the kind of build-up that was seen on the way up in expectation of a complete trend reversal will start reflecting in the numbers. The number will be MWPL, Market Wide Position Limits. Now, this is a number for the overall market that I update on my social media account every single day at the end of the session. If you connect with me on social media, my contact coordinates come at the fag end of this video. I can basically help you update yourself with this number. But I'm not talking of the market wide position limit of the entire market. I'm talking of MWPL of a particular stock. I'm going to share these charts with you, so bear with me for a couple of minutes more. Now, what we want to see and what we do know is that when the market is going higher, traders tend to buy and they are led by hope. I'm going to make money after I buy this stock. There's a lot of hope and expectation built into it. Hey, when the bears have extinguished their shorts and the prices start to slide again, hope starts to turn into despair. There's an element of depression, there's an element of sadness, and therefore the prices start to fall. Many weak hands will even hit their stop losses and try to get out of their long positions. That drives the market sharply lower. Is there a method in the madness, and am I telling you a strict game plan? Yes, I am. My friends, you must target only those stocks which have seen a humongous amount of build-up in its MWPL, individual stock futures MWPL, which tells you that hope was prevalent maximum in these counters. And when hope turns to despair, these counters will be hit the most. I'm going to share a couple of charts with you in the coming few seconds. So do watch out for those charts. Now, what we do see in the charts, in the case studies of these few counters that I'm sharing with you, is a very simple aspect. The blue line is the MWPL of that individual stock future. The red line is the price. Now, let's take the first example of Bajaj Auto. These charts are generated by our in-house statistical model, the IBEX, and they tell you that when hope was prevalent, the MWPL indicated by the blue line was building up and the price was going higher as well. Remember, this is a closing price only, so the intraday high might have been higher. And then the price went to the vicinity of 3,800. MWPL suddenly started tanking because hope turned to despair and depression. And what happened? The price collapsed all the way down to 3,550 from 3,800. Let's take an example of Bandhan Bank. Now, here again, the MWPL started rising because hope fueled rally saw the price go to 340. But then when it was realized that it was just a bear market rally, MWPL and the price both started tanking. Price bottomed out at close to 310, almost 10% lower. Take a look at Tata Consultancy Services or TCS. A rise in MWPL because the dollar was gaining versus the rupee and it was thought that export income of software companies would go up. MWPL and the price rose. The price peaked out at approximately 3,430 on a closing basis. And then when hope turned to despair, prices collapsed to 3,180 on a closing basis. The intraday low was lower. Here again, as you can see, a near 8% precipitous decline was seen on these charts. Remember, so what you are seeing is that you enter and exit within the same derivative cycle in less than a month. You're enjoying a 8 to 10% fall in the price itself. Now, do remember that we are talking about futures here. On an average, you're leveraging yourself 5 to 6 times. So an 8 to 10% decline in prices when you're short gives you approximately 45, 50, maybe even 60% return on investment depending on what the span margin is like. Now you're getting this kind of above average outlier kind of returns just for thinking smart. You basically started thinking like a hunter. You started tracking the prey that you want to catch, hunt and kill and have for lunch. This is the way a systematic trader starts to have a nose for trading profit opportunities. You start to monitor what happened at particular price points. Did a huge amount of hope see buying influence the price and push it up? Was the spread on the snapcoat window very wide at that point in time? Was the overall volume high or low? Okay. Now, this is why on my social media, I've been debunking the fact that the recent rally which we saw in the month of April and May was nothing but a bear market upthrust. Because all the items on my agenda were witnessing tick marks against them. Now, distance yourself from the crowds and don't get caught into popular perceptions or what is being bandied about in the social media through WhatsApp updates, etc., etc. Stick to facts, stick to numbers because numbers cannot be influenced. Better than distancing yourself away from the crowds, I feel you should stay ahead of the crowds using a combination of statistical analysis, behavioral finance, chart reading, and screen reading. Adopt a complete 360-degree worldview and stay ahead of the markets, my friends. On this cheerful note, I'll bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. In the comment section, good, bad or ugly, I'd love to have your feedback. And please help me reach out to fellow like-minded smart traders like yourself by referring my video to your family and friends. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Thank you for your patience and being with me in my video. Have a very, very profitable day. Take care. Bye-bye.